Every major financial crisis in modern history has followed the same pattern. The warning signs appear years before the collapse. Experts sound the alarm. Regulators promise everything is under control. Then suddenly, overnight, the system implodes. We saw this in 2008 when banks claimed their mortgage portfolios were rock solid right up until Lehman Brothers vanished in a single weekend. We witnessed it in the savings and loan crisis of the 1980s when regulators insisted the industry was healthy while hundreds of institutions were secretly insolvent. And we're seeing it again right now in 2025 as we march toward what economists are calling the inevitable 2026 crash. But here's what nobody's telling you. The crash hasn't started yet, not because the economy is healthy, but because of the most sophisticated financial cover-up in American history. The banks know what's coming. The Federal Reserve knows what's coming. The government knows what's coming, and they're all working together to hide the truth from you until it's too late to prepare. The 2026 recession isn't a prediction anymore. It's a mathematical certainty. The business cycle analysis that correctly predicted the 2008 financial crisis 11 years in advance now points to 2026 as the year when everything unravels. But this time, the crash will be different. This time, the very institutions we rely on to save us during financial emergencies are the ones orchestrating the cover-up. Let me show you exactly how they're doing it, why they can't stop what's coming, and what this means for every dollar you have saved, every investment you own, and every financial decision you'll make over the next 18 months. The cover-up begins with something called stress testing. On the surface, this sounds like responsible banking regulation. The Federal Reserve forces large banks to prove they can survive economic disasters by running hypothetical scenarios where unemployment spikes, real estate crashes, and markets collapse. Banks that pass these tests get a clean bill of health. Banks that fail face restrictions and penalties. But here's the dirty secret. These stress tests aren't designed to reveal bank vulnerabilities. They're designed to hide them. The scenarios are carefully crafted to make banks look healthier than they actually are. The timelines are compressed to minimize apparent damage. The assumptions are manipulated to produce passing grades, even when banks are sitting on massive hidden losses. For 2026, the Federal Reserve's severely adverse scenario assumes unemployment climbs to 10% and commercial property prices decline 40%. Sounds scary, right? But those numbers are actually conservative compared to what's already happening in the real economy. Office buildings across America are sitting 40 to 50% vacant right now. Regional banks are already carrying massive commercial real estate portfolios that can't be refinanced at current interest rates. The stress test scenario isn't testing for a future crisis. It's testing whether banks can survive the crisis that's already underway. And yet, bank after bank passes these tests with flying colors. Why? Because the tests are rigged. The models compress historical stress periods to make severe damage appear manageable over just a few quarters. The scenarios replicate past crises rather than accounting for current unique vulnerabilities. The Federal Reserve exercises discretion in scenario design, which is a polite way of saying they adjust the tests until banks pass them. This is an accident. This is intentional deception. The regulators need banks to appear healthy because the alternative is panic. If the true state of bank balance sheets became public knowledge, depositors would run. Credit would freeze. Markets would crash. The very act of honest stress testing would trigger the crisis they're trying to prevent. But the cover-up goes much deeper than manipulated stress tests. Hidden beneath the surface of bank balance sheets lies a derivatives monster that makes 2008 look like a minor market correction. 4 large American banks now hold 87% of the entire industry's derivatives exposure. We're talking about $223 trillion in notional derivatives contracts. That's 10 times the size of the entire United States economy concentrated in just 4 institutions. JP Morgan Chase alone holds $55 trillion in derivatives. That's 15% of the global derivatives market controlled by a single bank. Deutsche Bank carries $45 trillion in derivatives with counterparties so risky that 40% of their positions aren't even properly collateralized. These aren't investments. These are financial weapons of mass destruction that could detonate at any moment. Here's what makes this terrifying. During the 2008 crisis, derivatives losses at a single institution, AIG, required a government bailout of $180 billion. But that was when total derivatives exposure was a fraction of what it is today. Now we have banks carrying derivatives portfolios that are literally too big to bail out. If these positions start unwinding simultaneously, there isn't enough money in the Federal Reserve, the Treasury, or the entire federal government to stop the cascade. The banks know this, the regulators know this, but instead of addressing the problem, they're hiding it. Derivatives accounting allows banks to net out exposures, showing only small fractions of their true risk on balance sheets. Regulatory reporting requirements have loopholes big enough to drive truck convoys through. The public gets sanitized quarterly reports, while the real numbers remain buried in footnotes and supplementary disclosures that require forensic accounting to decode. Meanwhile, banks are sitting on another time bomb that's hiding in plain sight. Unrealized losses on securities portfolios now total $481 billion across the banking system. That's 8.6% of the fair value of all bank securities holdings. These aren't mark-to-market losses that show up in quarterly earnings. These are paper losses that banks don't have to recognize until they actually sell the securities or until depositors start withdrawing money and force liquidation. Think about what this means. Banks bought government bonds and mortgage-backed securities when interest rates were near zero. Now those same securities are worth substantially less because rates have risen to multi-decade highs. But as long as banks don't sell and depositors don't run, these losses remain invisible. It's financial fantasy accounting that makes bank balance sheets look solid, while they're actually sitting on $500 billion in hidden damage. The regional banking sector faces the most severe vulnerabilities. 59 of the largest banks in America have commercial real estate exposures exceeding 300% of their equity capital. These banks are essentially betting their entire net worth on a commercial property market that's already in free fall. Office vacancy rates haven't been this high since the Great Depression. Retail properties are being abandoned as e-commerce destroys traditional shopping. Industrial properties face pressure from supply chain reorganization and automation. But here's the kicker. Many of these commercial mortgages were written at 3 and 4% interest rates during the era of cheap money. Now they're coming due for refinancing at rates approaching 8 and 9%. Properties that could barely cover debt service at 3% are mathematically insolvent at 8%. The borrowers can't pay. The properties can't be sold for enough to cover the loans. The banks holding these mortgages are about to realize massive losses that will wipe out their capital buffers. FIRS. The Federal Deposit Insurance Corporation knows exactly which banks are at risk. They have detailed exposure reports. They monitor deposit flows. They track capital ratios in real time. But instead of taking preemptive action, they're playing a dangerous game of financial chicken. They're hoping these banks can somehow muddle through until economic conditions improve, even though every indicator suggests conditions are getting worse, not better. This is where the cover-up becomes truly sinister. The FDIC has quietly begun preparing for mass bank failures while publicly maintaining that the banking system is sound. They've increased their examination staff. They've updated their resolution procedures. They've even started preliminary discussions about how to handle simultaneous failures of multiple institutions. But they're doing all of this behind closed doors while telling the public that everything is fine. The Deposit Insurance Fund itself tells the real story. The FDIC maintains reserves to cover bank failures, but those reserves are calculated based on historical loss rates that don't account for current vulnerabilities. In a normal recession, the fund covers small regional bank failures scattered over several years. But if commercial real estate triggers cascading failures across dozens of institutions simultaneously, the insurance fund becomes mathematically insufficient. The FDIC would need to borrow from the Treasury or impose emergency assessments on surviving banks to cover depositor claims. And that's assuming the failures happen in isolation. But modern banking creates interconnected webs of risk that make isolated failures impossible. When one bank fails, it stops making payments to other banks. Those other banks suddenly face liquidity shortages, credit lines get pulled, lending stops, the contagion spreads faster than regulators can contain it. We already saw this dynamic play out in miniature during March 2023. Silicon Valley Bank failed on a Friday morning. By Sunday night, 3 more banks were in crisis. Within a week, the entire regional banking sector was under pressure. Deposit outflows accelerated across institutions that had no direct connection to the original failure. Only massive Federal Reserve intervention prevented complete sector collapse. But here's the problem with that intervention. The Fed's emergency lending facility that saved the banking sector in 2023 created moral hazard on an unprecedented scale. Banks now know they'll be bailed out if they take excessive risks. So instead of reducing their vulnerabilities, many institutions have actually increased their exposure to risky assets. They're gambling with depositor money because they know the government will cover their losses. This creates a perverse incentive structure where banks profit from risk-taking during good times and taxpayers absorb losses during bad times. It's privatized gains and socialized losses on steroids. And it guarantees that when the next crisis hits, it will be larger and more expensive than the previous one. The commercial real estate situation is already reaching critical mass. Brookfield Asset Management, one of the world's largest real estate investment firms, defaulted on 2 Los Angeles office towers in 2024. They simply stopped making mortgage payments and handed the keys back to lenders. This wasn't because Brookfield lacked resources, it was because the properties were worth less than the debt, making default economically rational. That default sent shockwaves through the commercial mortgage-backed securities market. If a sophisticated global firm with unlimited access to capital chooses to default on premium properties in major markets, what does that say about the thousands of smaller properties owned by less sophisticated investors? The answer is becoming clear as defaults accelerate across every major metropolitan area. Over $2 trillion in commercial mortgages matured during 2025 and 2026. Most of these loans cannot be refinanced at current interest rates. Property values have fallen so far that many borrowers owe more than their buildings are worth. The smart money is walking away, leaving lenders holding worthless collateral and massive losses. Regional banks hold the majority of these commercial mortgages. They're about to face the largest wave of loan defaults in their history. Their capital will be wiped out. Their regulators will have no choice but to close them. The deposit insurance fund will be overwhelmed, and the federal government will face impossible choices about how to respond. Central bank digital currency represents the final phase of this cover-up. While banks prepare for crisis and regulators plan for failures, monetary authorities are quietly building the infrastructure for complete financial control. 137 countries, representing 98% of global GDP, are developing digital currencies that would give governments unprecedented power over every financial transaction. The European Central Bank plans to implement digital euros by 2029, with supporting legislation targeted for 2026. Nepal aims for pilot programs by 2026. The Bank for International Settlements coordinates these efforts globally, ensuring that digital currency systems will be interoperable across borders and compatible with international surveillance networks. The 2026 crash hasn't started yet, because the biggest financial cover-up in American history is keeping it hidden. Rigged stress tests, derivatives time bombs, $500 billion in unrealized losses, and insolvent regional banks are all being masked by regulatory deception. When this house of cards finally collapses, it won't be gradual. It will be sudden, brutal, and unlike anything we've seen before. The warning signs are everywhere if you know where to look.